Ratios. I know you hate them, but it's good. It's good for us to learn something exciting. Besides, there's a funny anecdote for this anyway. So, number 13, selected problems. Let's look at it. Bunds is considering a significant expansion into its product line. The new products are a significant step in quality above the company's current products. But I'll have to purchase new high-tech equipment to make these new products. So we have some projections with and without the new products as follows. And so the ones I'm interested in, we'll look at them all. So if I stay as I am now, without the new product, right? Not buying the high-tech stuff, not getting the new and improved step up in quality of products, I'll have sales of 10 million. That's nothing to sneeze at, right? And when I have sales of 10 million, I have $500,000 of net income. And to generate that, I am using average total assets of 5 million. But if I put in this high-tech equipment, right, then it tells me that my sales will increase to 16 million. That's a pretty good jump from 10 to 16 million. And my net income will almost double. Net income will go from 500,000 to 960,000. But my average total assets will be 12 million. Be careful here. I only had $5 million of assets before, machinery and such, and now I'm going to go up to 12 million. This is a huge, significant investment. So there's a lot of things I should look at when I make this decision. But one of the things that I could do is to calculate my return on assets and see if this gives me any indication. So return on assets says how much net income do the assets that you use create. Well, when I look at my total assets, how much of them, what percentage of them help create net income? All right. So what are they returning? So in this case, all I want to do to get return on assets is to take my net income and divide by my average total assets. Now this should never be the sole ratio I use when I'm determining whether I want to buy equipment or not. And we'll discuss that in a minute. But currently, if I do nothing, my $5 million of assets is generating $500,000 of net income. There is a 10% return on the assets I'm using in the facility to make my products. And I'm getting income out of them. But after I buy these assets, my net income will increase significantly. And a lot of people look at the straight dollar amount. But we have to be very careful. In this case, my return on investments afterwards is 8%, meaning that this $7 million in high-tech equipment is not pulling its weight. It's not pulling its weight as much as the $5 million I had before. And in this case, if we were basing solely our decision on return on assets, I would say don't invest in the new equipment. But we have to realize that when we make these decisions, there's always lots of things to consider, right? And one of those things is it tells us in here that it's going to give us a significant step in quality above the company's current offerings. If this is the wave of the future, and if the products that I'm currently selling will no longer, in essence, become obsolete because everybody's going to want this new, high and improved quality of product, and I don't invest in the equipment to make it, I'm going to get left in the dust at some point. So a great example of that would be Blockbuster. I know you've been there this weekend to pick up your the new DVD of whatever is out. As we know, I don't watch TV or movies. But think about Blockbuster going through this decision, sitting in the boardroom. Gee, streaming movies. I don't know about this. You know, to stream movies efficiently, people would have to have high-speed internet. And right now, a lot of people, this is the 80s, mind you, late 80s, a lot of people don't have internet in their house. And if they do, it's slow. And in fact, only businesses will probably get high-speed internet, and they're not the sort that are going to watch movies. And the way things are working right now with our brick and mortars, like we're just racing to the bank, hand over fist and laughing all the way there. I don't think we need to invest in the equipment to high-speed stream movies. I mean, who's going to do that? Like, there'd be little use for that, right? And so they say no, the return on investment's not good. But here's the deal. Of course, Netflix did it. Once Netflix did it, everybody started to do it. They started streaming because internet became easier for us as regular, everyday, middle-class people to have in our homes. And so we all got the internet, and we decided we really liked to stream movies. It became something that we could all do. And by the time Blockbuster figured that out, it was too late. Everybody had beat them to the game. And I'm not saying that it was a return on assets ratio that threw them off, but in a situation like this, not only do you have to consider the ratio, you have to consider what's happening. And if this brick and mortar store and the actual DVD where you actually have to bring it back and all those other things is going to be something of the past, well then, we have to consider other things. Think about now. In fact, the reason I'm here and instead of in front of you live is this whole shelter-in-place thing. How well do you think Blockbuster would have worked in that situation? It wouldn't have. We wouldn't have been able to go. Streaming movies worked really well in this situation. Again, sometimes the future means you just have to invest because people will leave this behind. And so in this case, we should have considered other things besides return on investment. Okay, questions? I know, you can't ask, but at least not right here. But you could always email me, right? You could always Zoom chat me. You could text me. But barring that, we've got 2 more topics for this chapter. One is this idea of natural resources, and the other is intangibles. Let's start with natural resources. For us, a natural resource is something only Mother Nature can make. I cannot go in a factory and make it. So when we're talking about natural resources, I'm talking about things like diamonds, wheat, timber, ore, natural gas, oil, and the list goes on. Typically, we find these natural resources inside or growing on top of land. Right? And typically, if I lease that land just to take out the natural resource, or I buy the land so that I can get the natural resource, what this is going to become for me is my inventory. Right? I plan on harvesting this out of the ground or off of the ground. It's going to become my inventory, and then I plan on selling it. So as I take it out of the ground or off of the ground, right, part of the cost of the land was for the timber or the wheat or the diamonds. And so then I need to deplete my cost out of this land. And we're going to use units of activity. Because before, when I buy this piece of property that's got all the oil or the gas or the timber, I'm going to measure how much I think is there. And granted, it's an estimate, but that's like saying that that machine in our last example was going to last 60,000 machine hours, right? I figure out how many board feet of timber there are on there, how many, pounds of wheat, or however we measure wheat, or gallons of oil, right? And then I take the part of the cost of the land that I pay for that, divide it through, and every gallon of oil I take out, or ton of diamonds, or however we measure these things, board feet, then we will take it out of land and put it into our inventory, right? Because inventory is something I own that has value, so once I take it out of land, it is my inventory. So at one time, it's a lot harder to count than you might think. In grad school, we all had a project, and we had to come up with a solution. So I'm in the South, I'm in Alabama, and these are real companies. And Meade decides it wants to know how to count its board feet of timber on a piece of property. Those trees grow taller every year as long as wider. So even if I knew the amount of board feet that were there last year, and we've not cut down one tree, not one caught on fire, not one felled, right? I have to measure all the trees. Then we were cutting them down, they were putting them in a river, and they were sending them down to the sawmill. And I had to include on any given day figure out how many trees, board feet, were in the river in process to the plant. Never again. Granted, things are a lot easier with technology now, but in that situation I had to hire a plane or a helicopter, and we had to do part of this by the air. I don't like trees anymore. I didn't know how they could grow wider and taller, and then you had to measure them all. But, that said, let's take an example. Now remember, anything that it takes for me to get this asset for its intended use, it becomes part of the cost. So let's just assume, looking at 14, that I have a mineral mine, and I paid $2 million for it. But then I had to drill holes, right, into the ground and put, railroad tracks or those little cart tracks down so that I could get to the minerals. Okay? Getting that mine ready, drilling the hole into the ground, laying the tracks so that I could get down to the potential of these minerals is also considered a part of the cost of this mine and the land. So I spent $400 more so that I could get the mine ready for extraction. And when we do our estimate, we assume, right, I get a geologist or whatever, that there are 760,000 tons of mineral in the ground. We figure that by the time we take all the minerals out, I'll still be able to sell the land, but for not nearly what I paid for it, right? So the salvage value at that time is expected to be $500,000. So I paid $2 million for the piece of property, and then I spent another $400,000 drilling tunnels into the ground. And then at the end, when I'm done and I seal it off, I can sell it for $500,000. In addition to the mine, I've got 2 buildings that I constructed on this site. When I get all the minerals out of this mine, I'm not gonna undo those 2 buildings. I'm leaving them. So if that's the case, I have to depreciate the buildings, not for how long they will last, but for how long I will use them while I am extracting the minerals. Not only that, I have some equipment that's on site for $40,000. The difference between the equipment and the houses or the buildings I leave behind is that at the end of extracting all the material, I can actually sell the machine, and it seems to think that I can sell it for $2,000. And then it goes on and tells us that during the year 2018, I actually extracted 170,000 tons of the mineral out of the ground. So it asks us, how much should I deplete the mine for, and then how much should I depreciate that piece of equipment and the buildings that I put on site? So let's look at that. The mineral mine, when I got it, it said February, I think, 2018 or 17, 18. I'm just gonna call it mine. I paid $2 million for the mine. Let's assume I paid cash. And then at some point I drilled tunnels. I put that in mine as well. $400,000 that cost me. So I've got my mine out here, $2,400,000. They tell me, so that's my cost, right? Everything it takes to get it ready for its intended use, which is for me to pull these minerals out. I'm going to deplete units of activity. So I want cost minus salvage value. Well, cost is $2,400,000. Salvage value, $5 million. And then useful life. For us, with units of activity, useful life is the amount that I think I can get out of this mine. And they tell us that that is going to be 760,000 tons. So per ton, if I take in fact, this isn't 5 million, this is 500,000. Shame on me. When I take the $1.9 million, 2.4 million minus $500,000, and divide by the 760,000 tons, I need to deplete this mine at $2.50 per ton that I pull out of the ground. We can go about this 2 ways. We can have a self-wasting asset, or I can use a contra account. I'm going to self-waste this asset, okay? But it can be done either way. So just like having depreciation expense, we call this depletion expense. So the end of the first year, I'm going to debit depletion expense, and I'm going to do that for $2.50 a ton times the number of tons that I pulled up this year, which is 170,000. So 170 times 2.5, this gives me $425,000. And if it's self-wasting, as we call it, like we're going to do intangibles, it means I'm just going to credit the mine. So at this point, I credit this, and over time, every time I deplete something out, the mine self-wastes. It's going to waste back down to $500,000 if I do this right. Otherwise, if I'm not self-wasting, I would have credited accumulated depletion. Well, that's self-waste. Then it says, well, what about the buildings, right? I put 2 buildings up, they cost me $76,000. At the time I put those buildings up in February, I debited buildings, credited cash, $76,000. We are going to deplete these buildings, depreciate them, right, based on depletion, units of activity, over the number of tons in there. So again, I'm going to take cost minus salvage value. Salvage value is 0 because I can't haul these off. And then divide by useful life, which is 760,000 tons. And this comes up to 10 cents per ton that I'll depreciate these buildings. So when I get to the end of December, so this was in February of 2018, right? February. When I get to December 2018, I'm going to debit depreciation expense, accumulated depreciation. We did 170,000 tons, 10 cents a ton, $17,000. I'm also going to do the same thing for the equipment. Right? The equipment cost $40,000. There is a $2,000 salvage value. So for equipment, when I purchased it on February 2018, I debited equipment, $40,000. Assume I paid cash, $40,000. And then at the end of the year, when I get the per unit, units of activity, for depreciation, I would have taken cost, $40,000. There is a salvage value because we can sell these with $2,000, and I would have divided by the 760,000 tons. So if I take 38,000 and divide by 760,000, 5 cents a ton. So when I depreciate this asset at the end of the year, I will have depreciation expense. I will credit accumulated depreciation. Right, the 170,000 tons I did extract times 5 cents. 8,500. And assuming that I have all 170,000 tons still in my hot little hands at the end of the year, I will put it on my books as inventory, and I will put, remember, everything is in historical cost at that point. If I'm taking it out at $2.50 a ton, it'll be on my books in inventory as an asset, something I own that has value, at $2.50 for every ton I still have. If I sell them during the year, all of them, all those tons, then that 170,000 times the $2.50 becomes my cost of goods sold. Cost of goods sold is the cost of the item I sold, $2.50 a ton. That would be my cost of goods sold. Okay. And now, actually, we're going to take a break for just a minute before we do intangibles. I will see you back. Go get your coffee.